an RBA update where I catch up with Evan and we talk all things economics, both internationally for our biggest markets, and there has been a little bit of a movement there. So one of our key themes is some rate cuts in some of those international markets. And then we're going to take a really deep dive into a couple of themes today in relation to our GDP numbers, the immigration story, and also the latest inflation data. So we're going to go deep on that. And then finally, at the back end of our presentation, we are talking property. We're going to take a little bit of a dive into the costs of acquiring a property as an investor and also those ongoing costs in terms of land tax. So there's plenty to hang around for, and let's get into the show, starting with obviously where we normally do in the US market. So thanks for joining us, Evan. We'll get straight in because we've got so much to talk about.
We do indeed. And I'm going to basically let you go straight away because I've got a lot of country data that I want to go through, and it's sort of in the middle and the end. So please, as Ben said, not just that property story, but some other things that a lot of you are asking questions about with regards to where does Australia sit against the rest of the world, because the world is starting to move. Why aren't we?
Okay, so here we go. Straight into the US inflation story. So we saw the US Bureau of Labor Statistics. The annual inflation rate in the US unexpectedly slowed to 3.3% in May, the lowest in 3 months compared to a 3.4% in April and a forecast of that 3.4% as well. Core inflation also slowed to 3.4% annually, the lowest rate since April of 2021 and below consensus of a 3.5% reading. The monthly core inflation rate also fell by 0.2 of 1% from 0.3 of 1%, which was better than forecast, which was remaining at 0.3 of 1%. So that's a good story to start us off, Evan, in terms of what's happening when it comes to inflation.
Yeah, it is, and they needed it. Let's also point that out there very clearly. They needed a story like this because, as you can also see from the chart that Ben's got on there, and if you listen to it on the podcast, from the start of this year, inflation in the US in the first quarter ticked up. Like it went from 3.1 to 3.5%. We're now down to 3.3. The forecast expectation was for it to be flat compared to April, so at 3.4. So they needed that little bit of breathing space. I will, however, temper that with what Jay Powell pointed out in his presentation, which was that particularly around rental agreements and rental costs, they're still way too high. And he was worried about that. He points it out very clearly. And personal consumption is still high, and they need to get it to 2%. So, and it is a but, this is good news for the states. It is finally some news. What was so hard about that CPI data, Ben, is that it also came out pretty much, 4 or 5 hours before the Federal Reserve actually had their June meeting. So last week when we were looking at this, the data was coming so fast, the markets didn't know where to look, including myself, because there was just so much going on. But this is finally something they wanted to see. The trend is going down, and that's where we move to rates.
Yeah, so I got a lovely little segue in there. So the Fed Reserve left their Fed's fund target rate steady at 5.25 to 5.5% for the 7th consecutive meeting in June, in line with forecasts. To your point, Evan, the policymakers did not expect that it will be appropriate to reduce rates until they've gained greater confidence that inflation is moving sustainably towards their 2% target, which is sort of what you're alluding to in terms of, so a little bit of sticky inflation. And that sort of takes us into, this chart here, which is obviously the dot plot projections chart. So tell us what you saw happening here, Evan.
So with all that being equal, and again, for those of you listening on the podcast, I'm going to read the data out. So I have got here the dot plots from what was expected in March at their last major update to what we got in June. And the figures have shown that the expectation in March was that they were going to have 3 rate cuts by December this year. So they were going to see rates at around about 4.2, 4.5%. They've now revised that down to just a solitary single 25 basis points, so 0.25 of 1% rate cut by the end of this year. And it's a staggering move. But, and it is a very clear but, we just talked about inflation, a way that they were looking at it, that they'll be happier with it. What hasn't changed is once they start cutting, the expectations that they'll be pretty consistent. So if you look at the solid orange line, the expectation is that once they start, almost every meeting, they're going to be basically cutting at a quarter notch each and every time. So by the end of 2025, the expectation is that the rate will be about 4.1%. by 2026, it'll be as low as 3%. And that would therefore mean 4 rate cuts next year, basically 4 rate cuts the last after, with the one included that might happen this year. So that's what's happened. It's more about the time rather than the amount. So the time has been pushed back for when the first one's going to start. And I think that's the key takeout from this as well. So the dot plots have basically said, we're not ready, it's too early, but when we do start, it is signaling a start of a really strong cut cycle.
Yeah, it's interesting, even though they haven't made any changes yet, they also didn't make any changes to their GDP forecast, with growth still expected to grow, the economy expected to grow at 2.1% in the remainder of 2024 and at 2% in 2025 and 2026. Now, you think if they continue on that sort of hard cutting trajectory, they would have to change that late 25 or early 26 forecast to potentially even stronger growth in those markets. So that's not a bad story in the US, but we've still got a bit of sticky inflation there at the moment. Let's look at the US unemployment story there. And so we saw the US Bureau of Labor Statistics. They reported the unemployment rate in the US rose to 4% in May, the highest since January of 2022, up from 3.9% from the previous month, and surprising market expectations, which had the forecast that the rate to remain unchanged, right? So the number of unemployed individuals increased by 157,000 to 6.649 million, while employment levels went down by 408,000 to 161 rounded million. In terms of the labour force participation rate, dropped to 62.5% from a 62.7% previous reading, and the employment population ratio decreased to 60.1 from 60.2. So what's happening here is it's trending in the right direction if the Fed want to cool the economy. So even though they've got unemployment sort of still sticky, once you actually look at the longer trend, it's actually moving in the right direction in terms of the unemployment rate is actually moving up, which is slowing that broader economy. Isn't that right, Evan?
Yeah, and so again, this was the slight better than expected, if you can sort of call unemployment better than expected.
Yeah.
So it is, again, gets back to what you heard from the board, what Jay Powell said in his press conferences, that things are starting to show signs of what they would expect in a tight market with clearly a very tightening sort of bias with regards to where the overall economy is at. It's, again, the soft landing is certainly looking more and more likely. And I think that's also explains why the reactions to everything that Ben and I've just talked about have been positive, despite the fact that the data is technically negative, despite the fact that the Fed is not going to cut rates as soon as expected. The overall story is that it's materializing slower than expected, but it's happening. So that's how you look at it. Is the unemployment rate is ticking up, though we need it to get to about 4.5%. How long that takes is a good question, but I think more importantly, the chart, even this, is showing the trend is there, that it's just starting to incrementally move up.
Very good, very good. So we'll move on now to the consumer confidence and sentiment. Remember, in America, the consumer is enormous to their overall economy, quoted in some sort of economic commentators as around 65 to 70% of their overall GDP. So what we did see in the consumer confidence and sentiment survey from the University of Michigan, that consumer sentiment in the US fell for the third straight month to a reading of 65.5 in June. It's the lowest since last November and well below forecast of 72, which was the preliminary estimate showed. In terms of the assessment of personal finances, dipped due to the modestly rising concerns over higher prices as well as weakening income. So again, the economic flywheel is tightening up in the US, but they still want to see a little bit more before they start moving on interest rates. Moving along now, let's have a look at the retail sales. Well, we actually didn't get any retail sales data, so we're going to skip that for this particular month because we've already reported on the April retail sales at the time of recording. So we move now on to our business confidence and conditions. And what did we see in the Institute of Supply Management? We saw the IMS manufacturing PMI unexpectedly edge lower to 48.7 in May from a 49.2 in April, which also was below forecast of a 49.6. So softening manufacturing. The reading showed another contraction in that manufacturing activity as demand was softened again. Output was stable and input stayed accommodative, which basically means that we are starting to see that sort of move back through the cost chain, and that hopefully is putting downward pressure in terms of inflation, the inflation story there. Okay, so Evan, let's talk about the key takeaways. What do we think in terms of, in the last 6 weeks, what's been sort of the big stories coming out of the US economy?
Look, I think the big takeaway, first and foremost, the Fed's still in play, right? So there had been some that even suggested that the Fed wasn't going to move rates in 2024. So they are still in play. They are telling us enough. Don't forget, at the end of this month, there's 6 months left, right? We are halfway through the year. So it would be very, very unlikely for them to change their forecast again. Now, again, I say that because Jay Powell actually said that almost verbatim.
Yeah.
So that's where it needs to be. In terms of, first and foremost, rate cuts will probably start in this year. There's just a longer period out. Secondly, there is moderation happening in the areas they finally need it to happen in. So the US is a great lead for us because Australia's economy and economics is performing very similar to what the US was, unfortunately, about 4 or 5 months ago.
Yeah.
It's a really good look for what's happening here. So my key takeaway is that the soft landing is still there. The States is showing that soft landing means that it actually is a slow landing, I think maybe the better way of saying it to you. So that was my key takeaway, is that everything's still on the narrow path, as the RBA loves to say it, and the US is showing us what it will look like going into probably the start of 2025 for us here in Australia.
Yeah, and I think what we also are going to see in terms of later this week, we have a lot of important data coming out of the US. We've got the GDP numbers, which will be hugely important in terms of just how strong the economy is. We've also got those retail sales, which we just reported we didn't have. Manufacturing and services PMI results also coming through. So it's definitely we'll know a lot more by the end of this week in terms of just how, that prediction of only one rate cut by the end of the year is still going to play out. All right, normally we then move now to China. And, Evan and I, before we started recording today, we were sort of saying there really isn't a lot going on in the Chinese market. So they're really...
It's weird to say, right? It's weird.
It's super weird. Our second biggest economy in the world. What are we reporting? Like inflation went down by negative 0.1 of 1% for an overall reading of 0.3. So that's anemic, and obviously rates remained on hold off the back of that. They haven't done any more stimulus. So there's nothing really to report there. I think probably the biggest news, which is a really important segue into, the European market, is what the Europeans announced around, EVs. So electronic vehicles, cars, and tariffs being introduced to protect their huge car industry out of Europe. And what's going to happen there. And that's also on the back of, the US also looking to put tariffs in on those EV vehicles coming out of China. Now, what does that mean for Australia? I reckon we're going to get really cheap Chinese-made electric cars flooding our market. So prices could be pretty good for buying a new EV out of China in the next couple of years. But more importantly, there really wasn't anything more. The Premier of China has come down to Australia. There's a little bit of a panda story there, and we'd love to see live lobsters. Love to see live lobster starting to be imported back into China. We'll see what happens there as part of this trip, but it's a bit of a PR trip. All right, so let's move on to Europe. So obviously, quickly, the big news out of Europe was we did see a rate cut, so we're going to talk about that very, very shortly. But let's start with the inflation story. So Eurostats released their annual inflation rate in the euro area, rose for the first time in 5 months to a reading of 2.6% in May from a 2.4 in each of the previous 2 months. And that was above forecast of a 2.5% preliminary estimate. Now, in terms of the core rate, which excludes those volatile items such as energy and food, alcohol, etc., tobacco, also increased to a reading of 2.9% from 2.7%. And that was also higher than what was forecast at a reading of 2.8. So now, among those major economies, inflation accelerated more than anticipated in Germany, 2.8, France, 2.7, Spain, 3.8, and Italy, 0.8 of 1%. So this and also moving in terms of the latest Eurosystem staff projections for both the headline and core inflation has been revised up in 2024 and 25, I should say. So staff now see that headline inflation averaging 2.5% in 2024, 2.2 in 2025, and 1.9 in 2026. Now, this for inflation, excluding energy, food, and staff, also projects, so this is core inflation, 2.8, 2.2, and 2% respectively over those next 3 years. So this was after that first rate cut that we're about to talk about, sets a bit of an indication. And I'll get to you in a minute, Evan. I'll just quickly finish off on in terms of talking about. So what did the cash rate do? So effectively, the news out of the Eurozone, the ECB lowered their key 3 interest rates by 25 basis points in June. This was in line with expectations, making a shift from the 9 months of stable rates after inflation declined by more than 2.5 percent points since September of 2023. The main refinancing operations rate, which is the big one, that most of us have as households, was lowered to 4.25%. The deposit facility rate was lowered to 3.5%, and the marginal lending rate was lowered to 4.5%. So that's good news. However, because of the recent inflation data, the last reading showing an uptick in inflation, the ECB Council aims to keep policy rates succinct in terms of restrictive, maintaining a data-dependent approach. So effectively, what does that mean? They're just basically saying that we're going to be informed by our data in terms of when and where we make that next move. So over to you, Evan, in terms of what did you see in that particular story?
So Christine Lagarde, the head of the ECB, had basically told us that this was happening. She's been telling us this for probably about 8 weeks. There would be even an argument, maybe even as far back as 12. So what some economists are trying to point out with that inflation read is that the population knew they were getting a rate cut.
Yep.
And therefore you've seen a tick up in spending because they knew they were going to get some more additional money in their pay packet because they weren't having to put it towards the loans that they're servicing. So that's one argument that I've been hearing. Second is, at the moment, if you look at particularly highlighted Germany, which I think is a really good one to highlight, the economics in there is getting slightly better. Exports have been slightly higher. Yep. If you look at demand out of Europe, it's been slightly higher. The other thing that you've got to remember with the Europeans of late is that their currency historically is cheap compared to particularly the US, and particularly if you go into parts of Asia, barring Japan, that's a different story. But they also, therefore, European attraction of products has gone through. So there's a bit more money coming into companies. It explains why things like the Euro 600 is at a record all-time high, because earnings have been slightly better. So putting that all together, you can see why there's been a slight increase in inflation. What I also want to point out very clearly, though, is that there's still a lot of pessimism going into it. I know we'll talk about it in a minute, but it also suggests that although Lagarde and co have said that they're data dependent, the data is enough to still say that by the end of the year, there's probably going to be another 2 rate cuts in the ECB because they're in a different scenario to the US and for us here in Australia.
Yeah.
Completely. So let's actually go through that to explain why.
Yeah, so ultimately we didn't have any new unemployment data that came through, so we'll move on to what we did see. Yeah. And this is that consumer confidence and sentiment story that we were talking about. So what we did see from the European Commission, they released their consumer confidence in the Euro area rose by 0.4 points from the previous month's reading of negative 14.3 in May, in line with those preliminary estimates and slightly below market expectations of a negative 14.2. Now, this result reflects a modest improvement in sentiment off the back of the cooling inflation and the overall trend in terms of the sense at this time of recording the data. So what we did see here was they to your point, Evan, they knew that this was coming, and so that's starting to show up in the sort of sentiment data that we basically saw. But it's still overall quite pessimist. Yeah. It's a negative 14 still says to me that there's that still remains deeply pessimistic. So hopefully we can see a turnaround in the confidence in that particular market. All right, let's move on now to looking at the again, retail sales weren't available at the time of recording, so we now move into the business confidence area. So what we're seeing here is business confidence in the euro area increased to a reading of 0.39 points in May from a negative 0.51 points in April. Just like the consumer, there is a small initial bounce off the back of pending interest rate announcement, which based in the timing of the data occurred after this data was captured and reported. So we'll probably see an even better bounce, won't we, Evan?
Yeah, we will. But again, both the consumer confidence and this one shows you very clearly that overall the pessimism in Europe is quite high, despite, as we spoke about before, actual GDP export data showing that things are moving in the right space. But I also want to go back to what you said about the inflation data as well. You've got to remember the Eurozone is an incredible mishmash of so many different economies and thought processes. So although Germany's doing okay, you listen to what you said about Spain, which is, growing an inflation rate of 3 and a bit. Then you've got Italy that's basically got anemic inflation.
Yeah.
The geopolitical stuff that's going on. So that's why the Eurozone is always very tough to turn around and go, it's good, bad, or indifferent, because there are good, there are bad, there is indifferent across the zone at every point in the cycle. So again, collectively, you've just got to look at this. Collectively, the ECB's got to go, the whole zone is feeling this, and that is pessimism is up. Inflation is slightly higher than we wanted, but overall, it's pretty anemic. And that's why, again, I get back to the point, the market's pricing in for the whole zone, not just for individual countries, is that by December, probably we're going to see 2 more rate cuts. And I think those 2 charts highlight why that's probably likely to be the case.
Well, I mean, you just need to look at the chart we've got on the screen now, which is, that business confidence. It's choppy, it's bouncy, there's no real leading or lagging indicators in there. So hopefully through the ECB's move to just, sort of signal that there's the one cut, more to come if the data and inflation remains in check. And then hopefully, we'll start to see that moving from pessimist to more optimistic outlooks in the future. Look, we didn't, in terms of the overall takeaways that we saw for Europe, so let's round them out now. We've always got to remember their target range is that sort of 2 to 3%. So we know the US Fed is 2%. In Australia, it's 2 to 3%. And in the Euro area, it's also 2 to 3%. So that's something that allowed for that 25% basis cut for interest rates. And so that gives us a bit of an idea in terms of what's happening over in Europe. It's still very, very choppy over there, and it's going to be more difficult for the short term, but hopefully there will be a little bit of sunshine, hopefully in the next 6 to 12 months in terms of what's happening in the EU area. All right, now let's rip into the Australian data. We promised a deep dive into the Australian market here. So we're going to start with our GDP numbers. So we get them quite late compared to other countries around the world. Our Bureau of Statistics reported these earlier this month. And so what did we learn about the Australian economy? So the Australian economy expanded by just 0.1% in the March quarter. And overall, on an annual basis, year on year, it was 1.1% higher. Now, that's easing from a 1.6% growth that we saw in the previous quarter. So, those breaks are definitely, sort of the interest rate breaks are starting to apply. And it was still also below market forecasts of a year-on-year 1.2%. So this is the slowest expansion since the fourth quarter of 2020, and that's actually when COVID arrived in terms of what's going on. Now,
I'm going to jump in there because the other thing that needs to be pointed out on the actual headline figure is that barring COVID, it's the worst quarter and worst year-on-year growth since the recession we had to have. So you need to probably look at it. We are far enough away from the COVID scenario to actually be comparing ourselves with apples and apples. That is how slow we are growing. We are now growing at what would be normally seen as a lead into a pretty stagnant, stagflation, growth sort of burden that we're feeling. And we know that, and I know I'm going to talk about it, but I think we need to sort of also remember just how low 1.1% growth is. It's back in that early 90s where we fell into recession.
Yeah, so and again, by design in a way, if you're thinking about it. So let's take a closer look at what's causing this. The subdued domestic demand, it's really playing on it, and also a fall in investment, fixed investment that is really dragged down that result. So household spending grew by more than 0.4 versus 0.3 in Q4, mainly on essential items like electricity, rent, food, health. So technically not real growth, just higher prices on the back of inflation. Yep. So remember those. They're all the main ones that are just as essential. Government spending also rose by 1% versus 0.8. This is going to be a big talking point for us over the next few months when we do these updates, because there is a lot of stimulus going on both at the federal and state government level, which is driving demand, causing this challenge between fiscal policy and monetary policy. And so that also extended benefits to the household. At the same time, fixed investment shrank further, negative 0.9% versus negative 1.5%, with private investment down for the first time in 5 quarters due to drops in non-dwelling household investment, ownership transfer costs, and total dwellings. Imports of goods and services rose 5.1%, while exports just added 0.7%. Finally, and this thing is what I want to talk about most in this, is the household savings ratio. So let's have a look at this, the next chart here. And this is from the ABS, that household savings to income ratio decreased from 1.6% to 0.9% in the March quarter. Savings fell as the rise in nominal household consumption outpaced growth in gross disposable income. So plenty to talk about here, Evan.
Yeah, there is. First, finally, before you move on to what I'm going to talk about, which is real GDP versus per capita, inventories were a massive surprise in terms of what came in that GDP figure, which helped to the upside. There's another way to look at that. If we've got higher level of inventories, it means it's not moving.
Yeah.
Right. So this is what I think also gets masked. Oh, look, it's but hang on a minute. If inventories are growing, that means stock is sitting. It's on hand and not moving. And that will therefore be reflected in the next GDP, where inventories are likely to start basically flatlining and holding. Because again, as you point out very clearly, the savings ratio is anemic. So buying up of those inventories are low, and investment also is part of that, because inventories normally go into business products, business machinery, business goods. So that was also something that I think masked a lot of this, is that inventories was so much stronger than expected. That, I would argue, is not a good thing.
Definitely not. And, looking at this savings chart here, we're now exhausting some of those buffers, and most households now. And so we will start to see the sort of mortgage in arrears again start to tick up. Now, we've got some positive news on the employment side, which is sort of, again, masking some of the challenges that households are facing. But it really, we've been talking about this at the end, or I spoke about this at the end of last year, that these are the things that I'm looking for in terms of, are households slowing down their spending, or are they still spending like they are because they've still got buffer? Well, when that buffer is taken away from them, then obviously, even if they want to spend, technically they can't unless they go into further debt and personal debt. So I always keep an eye on the ratios of how much household personal debt is increasing outside of the mortgage. And then we also know that we've got obviously stage 3 tax cuts kicking in from 1 July, which is going to give a little bit of money to, those lower household income earners. And that's, that potentially is going to be forced spending as opposed to discretionary spending. And so the big question that the government is sort of projecting to us and saying that they think that most people will save that money. I'm not so sure.
Let's have a look at that.
That's going to put a little pressure on it, right?
Yeah. So I brought in this chart that I think really is important to now look at. So this is from the guys at IFM. The reason I wanted to show it is we keep hearing about per capita GDP and real GDP. And you can see very clearly we know about what's going on. So this is a rolling 6-month change of quarters. So it gives you a much more consistent level of data. We are now into our 5th consecutive quarter of negative per capita GDP, which realistically is the household. The household is in recession. That's the way to look at per capita GDP. And you'll probably know that. Listening to me saying that, thinking about what you're having to do in your own household budget, you're probably feeling that pressure, which is the recessionary pressure of the household. But we're not alone, and that's what I wanted to point out here is very clearly we are the same as pretty much most of the European countries, New Zealand and Canada. Now, I'm going to come to those two in a minute because New Zealand and Canada are fascinating because they are very similar economies to us. But what it's also showing is that part of also why we continue to keep going as an economy is migration. We keep hearing about this over and over and over again. The reason for it is that it brings initial demand every single time. Every time somebody else comes into the country, the population grows, their demand is added in, and therefore it's not included from last year because they weren't here. So that's why, per capita is like for like is another way to say it to you. That I think is fascinating. So what I've also done is I've brought in the population growths for 3 other comparable economies, and that's what this is here. This is to show the population growth of Australia, the UK, the US, and Canada over the last 20 years, and just to show you how big Australia's population growth is. And then look at Canada. So Canada is very similar. They're a little bit different in some respects. They've got much better productivity than we do, but they have a lower level of overall productivity and employment. So that's interesting. But we are so far ahead in terms of migration. And that real GDP figure versus real per capita GDP, I think is so telling. Because realistically, Australia is in recession. And I think that needs to be pointed out very clearly because the household knows it's there. They are, despite we're still spending, it's, as Ben pointed out, it's spending on essentials. It's not spending on everything. Now, I know we're about to counter that in a minute, Ben, with regards to some of the spending data that's been changed. But overall, the reason GDP in this country is remaining slightly better than expected is that despite the fact that it's at the worst since the early 90s, we have this population growth that is offsetting all the other issues.
Yeah, and why do we bring that population in? Because there was demand. Ultimately, we felt like there was wage demand or an employment demand because the economy was moving quite well pre-COVID. And then, we put $90 billion into household and businesses. And that has obviously then meant that people are going out and spending that. And we need staff to run those businesses. So it is this cycle, and that's why we call it the economic flywheel in terms of how these things happen. But it's also politically quite good for Labor federally because it means that we're not in a overall recession, we're only in a per capita recession. And so, that's the challenge that they have in terms of convincing people that they can run a strong economy without sort of going into further debt. But we did see, obviously, in the last budget that we've got a more stimulus budget, and that is to the point the household is in recession, but government spending at the federal and state levels, the big builds that are going on, is also propping up the broader economy and also keeping a lot of those people in jobs. Now, what did that mean in terms of for the inflation story? So we move off those GDP numbers that we spend a bit of time talking about each quarter. Let's talk about what happened with the inflation year on year. And we saw that the ABS reported that the June monthly, CPI, won't be released until the 26th. So the numbers that we've got now, that'll be coming out next week. So let's talk about, that sort of year on year trend. And when you look at the chart, it's showing a pretty good story, right? So if we lift our eyes and not focus on the month to month reporting that we get a little bit choppy sort of data. The actual trend is our friend. And this is potentially one of the things that the RBA would be looking at to sort of say, we've got a narrow path, but we're still sort of slowly moving down that narrow path. So we did see quarterly inflation year on year period was 3.6% in Q1 of 2024, and that was down from 4.1% in the prior period, and that was still above market expectations. They were hoping for a 3.4% reading. In terms of the monthly CPI, increased by 3.6% in the year to April, and that's up from 3.5%, which was above those forecasts of 3.4% again. So this latest reading points to the highest since last November. So it's still, we've still got this stickiness going on due to mainly, faster rises in food and non-alcoholic beverage prices, 3.8 versus 3.5 in March. Fruit and vegetable prices advancing, again, probably off the back of poor conditions and sort of growing conditions also started to flow through in regards to those particular things. Prices also climbed for health, 6.1 versus 4.1%. Alcohol and tobacco, 6.5% versus 6.1%. Communications, 2% versus 1.6%. Clothing and footwear, 2.4% versus 0.3%. Prices continue to rise for housing, 4.9% versus 5.2%. Transport, 4.2% versus 4.5%. Education, 5.2% versus 5.2%, the same as last result. And conversely, prices fell for recreation, negative 1.3% and negative 0.6% of 1%, and furnishings also negative 0.8% of 1% versus 0.1% reading in the previous month. So when we actually start to think about the overall monthly inflation read, which is now on the chart, you can see this is what would be concerning. So if you can have a look at the visuals again, if you're on the pod, it's just telling a bit of a story that we made some really big inroads in terms of, sort of getting and taming a little bit of inflation, but it's starting to creep up a little bit. So I think this is why we're going to, wait for the RBA to see what they're going to do in the coming months. And it's really going to be dictated by probably the quarterly results more so than the month-to-month results. And if we have a look at those, Evan, and I'll get you to have some comments here, take a look at what you see here in terms of the the different charts around the different breakdowns.
Yeah, and so very clearly, you need to have a look straight out at the ones that make up the most in the CPI basket. So that is health, housing. You need to also have a look at things like food and non-alcoholic beverages, although it's not included in the overall ones, and then insurance and finance, right? So the reasons you put them there, that together, along with transport, is around about 55% of the total CPI basket. So they're the ones that matter. They're the ones that actually move the dial. We can talk about, alcohol and tobacco. It only makes up 2%, so it's pretty marginal, and they move and fluctuate quite a lot. You can talk about, things like furnishing and household expenditure. Again, not a huge part.
No, the weighted basket, but the housing story at 26% or roughly 25% of the weighted basket is
That's
a problem.
big part.
Yeah, that is a big part, and obviously rents are not going to slow down if investors are going to keep passing on their increased costs from governments around that. And we noticed that it was reported, and we'll find out when the New South Wales government releases their budget today. But effectively, we're also seeing the threshold for land tax, the indexation that's been going on, is going to be stopped. So that will start to see more bracket creep of landholders who have holiday homes or investment properties in New South Wales starting to have to pay some more land tax. Now, it's a pretty healthy sort of buffer that they have, like in terms of when does that threshold kick in? It's over $1 million. So that's a good news story. But by then capping that, it does mean that more and more investors will actually have to start paying land tax in New South Wales, which ultimately means there'll be more pressure on rents in that particular market. So certainly housing is not the area where the RBA or the government are going to see any type of healthy outcomes from inflation over the course of the next 6 to 12 months, even a couple of years. The way in which that whole system is pretty broken at the moment.
Yeah, which means it has to come from other parts. So I wanted to bring this in. So this is the main core components of the inflation rate. So the little bar charts, for those that are looking at it, are the quarter-on-quarter numbers. The lines are the year-on-year. For those of you listening out on the pod, the thing to really look at here is the trim mean and the weighted mean inflation. So that strips out food and fuel, strips out those volatile items. And as you can see, it's just starting to flatline and tick up in some parts of it. And that therefore needs to be very much watched out, because as Ben just highlighted, that includes housing, right? And a big chunk of that includes housing, includes education, it includes health. And these are the things that I spoke about at the last update, those tradable versus non-tradable things as well. They're all in here. And they're the ones that the RBA is now starting to go, hang on, this is becoming a bit of a problem. Yes, we've done a huge amount of heavy lifting, and the chart tells you that we've done a lot of heavy lifting, but we are still now not returning to target 2 to 3% in a timely fashion. And as they'll point out, more and more as time goes by, the worst compound interest plays against us here. Don't forget, they look at inflation on the same reasons that we talk about compound interest for your investment. They talk about this for your purchasing power, because if we leave it at 3.6 or 3.8% versus 2 or 3%, in 5 years' time, the difference is 20%.
Yeah.
Right? The difference is 20% in your purchasing power. So although we're feeling pain, and that's absolutely what it is, the concern for them is that in 5 years' time, the pain will be even more than what we have now, and it will be even bigger for the socioeconomic. So that is what is now getting to the RBA, is that we've done heavy lifting, but we're at that last bit, that last strain, shall we say, of pushing out that last little bit of inflation killing. It's just not happening. So that's why there's a concern, and that's why they're jawboning it at the moment.
Yeah, so it's the final mile. It's the hardest that we're going to have to try and bring that down. And to your point, Evan, it's potentially the difference between, say, 20% erosion of your buying power versus only 10%.
Correct.
So those numbers matter. And it obviously just means our society generally is a more expensive society. So that's not where we want to be. And part of that story has to be obviously productivity. And we'll come back for that in a later episode later in the year. Where we really take a focus on some of that productivity, because we have seen some of that move forward. All right, so what do we see there in terms of the RBA governor and the board? They met today. Michelle Bullock and her team, they've met over the last couple of days. And what did they decide to do? Well, they still remain patient. So they kept the cash rate on hold for the fourth meeting of 2024. They've decided to keep the cash rate at 4.35%. from after those 2 days meetings. Now, they're continuing to hold the line that the trend is their friend, but it's about how long they're going to hold this patience, isn't it, Evan?
Yeah, and I'm glad you said that, because I think what I take out of it is their patience is wearing thin. And what is also clear from what we've seen in the statement and in the reactions today, but also over the last 2 to 3 weeks, Michelle Bullock at the Senate testimony, Andrew Huser, who I'll come to in a minute as well, what they're clearly saying is that before the May budget and before the state run-ups to elections in some states as well, that they'd factored in the statutory tax cuts. They knew that was coming. So that was a done deal. They knew what that would do to inflation, but they weren't expecting an additional $19.7 billion in the first 2 years and another 24 over the first 4 years from the budget expansion from the feds. That, therefore, is part of it and what the reaction will be to that. They're also suggesting that spending is a little bit better than what was forecasted. And you and I were talking about this beforehand, was, last year's retail sales has been moved to the upside because of statistical data. So I would agree with you. They are patient, but as I said, they're wearing thin, and they are going to say, and have said very clearly, they will not hesitate to raise rates again, to jolt us into the understanding that we've got to get inflation back to that 2 to 3% band that you and I have just talked about.
And so their next meeting is not until early August. Remember, now they do 6-week cycles, so we won't have anything in July. But what they will have for that meeting is obviously a lot more data in their hands about sort of what's happened in the second quarter and how that's starting to look, and also obviously updated unemployment data and all of the general movement of data that they need to do to be informed to make that decision come August. So let's move through some of the other data that we've seen throughout the course of the last 6 weeks. So we saw the ABS report, the unemployment data, and we saw a seasonally adjusted unemployment rate. It inched down to a reading of 4% in May from April's 3-month high of 4.1%, which did match market expectations. In terms of the number of unemployed individuals, fell by 9,200 to a reading of 598,900 people, which is still nearly 110,000 fewer than before the pandemic. So it's still a good story in terms of the number of people that are gainfully employed in this country. People looking for part-time work dropped by 18,700 to 199,600, whilst those seeking full-time jobs added a further 9,600 to 399,300. Overall, employment increased by 39,700 to a reading of 14.4 million. Breaking that down, full-time employment work has advanced 41,700 new jobs to 9.9, but the part-time employment declined by 2,100 jobs to a reading of 4.46 million. Let's move on to the participation rate. Stood at a 6-month high of 66.8 compared to the estimate of 66.7. The underemployment rate stayed at 6.7%, remaining 2 points lower than the March reading of 2020. Additionally, monthly hours in all jobs decreased by 9 million or 0.5% to 1.951 million. Now, I don't like that when I see those decreasing in job hours, because that obviously impacts on productivity. So we don't have any latest productivity data coming out from that. But then when we start to look at that participation rate that we just talked about there, we can see that participation rate is moving up, which is obviously then puts more pressure in regards to the unemployment rate. So we can see that number there. And then finally, what we are going to talk about here is this really tight jobs market, Evan. And talk us through this particular chart, because it is really interesting. And it's why I suppose the economy is more resilient, that if we all had said 13 rate rises or whatever are coming, now we're sort of seeing so many people holding on to their properties. And this is part of that reason, isn't it?
Yes, it is. So the participation rate, first and foremost, isn't on here, but I want to talk about it as being incredibly strong. So when you break it down into gender, record participation by females, right? And I'm going to come to that in a minute as well. We've also got a record level of sort of movement in migration that we spoke about the last time. Why that all matters is that what's also happening in the employment market is that more and more people are coming back and interacting with it. So those that weren't even included in the survey, that weren't actually technically, inverted commas, unemployed, they weren't even in the system, are now coming back in. So that's why we've seen this tick up in unemployment, which is what you would expect anyway. But there's another way to look at it. It means that they actually think they can get a job. Yeah. Because that brings us to this chart. And this chart here is actually outlining the numbers that Ben just had. So this is the unemployment rate, the underemployment rate, and the underutilization rate. Now, what does that actually mean? Unemployment, you obviously know what that is. Underemployment, Ben sort of highlighted it to some extent. That's those that are employed but want to work more. Then you've got the underutilization. That's the combination of those two, unemployment and underemployment. Gives you the underutilization. And what you can see, it's just ticked above the level that we got to at the bottom of 2009, but it's at a 20-year low. And that shows you that the unemployment market is tight, right? It means that actually the economy is absorbing a whole heap of employment quite well. And that's why we've got, unemployment at the lowest it's been in basically almost 30 years, because it is actually lower than what it got to at the bottom of 2009. The underutilization rate and therefore the underemployment rate is also at really what we call squeezable levels. And that brings me into the final line that's there, which is wages. And on that wage number that's there, you can see wages have ticked above 4 and a bit %. This gets back to the inflation story. If we're getting wage growth, it's great. Yes, it helps the cost of living, but does add pressure into demand. If you've got an employment market that's pretty tight and pretty full, employees can ask for better rates and for better wages, etc. And that's what this needs to be showing, is that the pressure in the economy from the employment side isn't there. It somewhat explains the impatience that the RBA is talking about. They are concerned that there is still this overall view that, employment is good. And I spoke about this, I think, not last update, but the update before. Although household finances are in the doldrums, although forward expectations of the economy is in the doldrums, what's not is our expectation around our employment. It's actually near a record. So we basically believe that if we were to lose our job, we could go out tomorrow and find a new one almost instantaneously. So that's a disconnect. And that's what this chart, I think, is really important to show, is that we've still got a really good employment market despite all the challenges that we're facing.
Yeah, and the longer that employment market stays firm, the harder it is, in terms of being able to then move that sort of the inflation story down, which will then start to bring more, cash into the economy and certainly more disposable income into all of our pockets as mortgage holders as well. I think this also is a great chart here, Evan, in terms of let's talk to the multiple job holders. That's the sort of piece around holding on to the property that we talked about earlier. Yeah,
so that's a perfect lead in. So that's what I was going to say, is that what also happens in a market like that, and hours being worked, etc., and not having enough, hours to actually generate the income that you need to live, is that the amounts of multiple job holders is basically at a record all-time high. So there is now 973,987 of us in this country that have multiple jobs, side hustles, whatever it happens to be, with an employment number growth of that of about 6.7%. I mean, that's incredible. But you're right, Ben. It shows, again, it's the behavior that you and I love to talk about. Shelter is, and is always seen in the surveys, in the top two, normally the number one. Sometimes it's health, but normally the number one, the most important thing in a household, to keep the shelter you have, whether that's through renting or through the house that you live in. And if you're feeling the pinch of having to service that, this is your reaction. This is what you go and do. You go and work harder to basically service what you have. Push-pull, right? The flywheel Ben keeps talking about, because the more of us that keep doing this, the more disposable, inverted commas, income we have, the more money we put back into the economy, the RBA's job gets harder. I get that. That's a theological debate we can have over and over again, but theory is all well and good. The reaction is clear and the reaction is evident. And that's why I thought this chart was so telling as well, is that it shows very clearly what we as a population are being forced to do to basically, move around the economy we find ourselves in.
Yeah, and we'll prioritise that to hold on to our homes. Okay, let's move right along now. We didn't see any consumer sentiment data released at the time of recording, so we'll come back for that with a big update in the next economic and RBA update. Moving along, though, we did get our retail sales in that consumer spending from the ABS, and we saw the retail sales rose by 0.1% month-on-month basis in April, confirming those preliminary estimates and rebounding from a 0.4% fall in the prior period. The upturn was attributed to the recovery in sales in household goods, 0.7 versus negative 1.4 in March. Department stores, 0.1 versus 1.7%. Cafes and restaurants, takeaway food services, plus 0.3 of 1% versus negative 0.2 of 1%. And other retailing, 1.6 versus negative 0.1. So they're all, telling us that consumers are still spending strongly. At the same time, we did see sales for clothing and footwear decline at a softer pace, negative 0.7 of 1% versus 4.6 from the previous reading. And then while food reversed its previous rise to be negative 0.5 of 1% versus 0.8 of 1% positive in the last reading. Now, in terms of by regional, trade went up in New South Wales, South Australia, but it fell in Victoria, Queensland, ACT, and stalled in Western Australia, Tassie, and the Northern Territory. On a yearly basis, retail sales has grown by 1.3%, up from the 0.9 increase in March. Now, we've got to remember that that's purely based on that immigration story that we've been talking about, in terms of that's not necessarily all the consumers spending more. That's just basically more consumers actually consuming that's giving us this type of reading. We know also on a per capita basis that consumer spending has been down and retail sales have been down on a per capita basis. Let's keep moving. In terms of looking at the business confidence data, we saw the NAB Business Confidence Index fell by negative 0.3 in May from an upwardly revised +2 in April, pointing to the lowest level in 6 months and turning negative for the first time since last November. This is important. Mm-hmm. This is basically saying that businesses have been trying to keep spinning their plates and holding on, but it does finally see that the rate cuts and the disposable income is starting to catch up on businesses. And we're starting to see an increased number of businesses going into administration and liquidation and closing down. Now, these latest results suggest that the subdued economic activity in Q1 has continued into Q2 and sentiment worsening for manufacturing, transportation and construction. Business conditions were also below average with a reading of 6 versus the last reading of 7 in April, weighed down by drops in sales, 10 versus 13, and profitability, 3 versus 6. Profitability ultimately means that businesses start looking at their cost base. That means they start looking at where they can save on some of their input goods and also potentially saving when it comes to their number of staff that they've got employed. So watch out for obviously putting greater pressure on the unemployment story. Forward orders stayed negative 6 versus negative 7, led by retail, wholesale and construction. Capital utilisation almost unchanged, 83.3% versus 83.2%, whilst CapEx shrunk 4 versus 8. That did surprise a fair few economists out there. Labour costs growth rose. This is, what Evan was saying before about those real wages have started to go up, and that's starting to come through in terms of those labour costs, 2.3% in the quarter. In equivalent terms from the prior 1.5%, and purchase costs also had growth increasing by 1.9% from 1.3%. So these types of numbers add to that downward pressure on rates, and we do expect that will also put downward pressure on that labour market and, with regards to those increased costs. So it's turning in terms of that particular story. Now, when we actually start to think about our property story, let's start talking about property finance. In April data, seasonally adjusted terms, the value of new loan commitments. So total housing rose 4.8% to $29.4 billion after a rise of 3.8% in March. It's now 24.6% higher compared to a year ago. Owner-occupiers housing borrowings rose 4.3% to $18.5 billion and was 18.7% higher compared to a year ago. And for the investors looking to grab a small supply of investment properties out there, what we did see was a rise of 5.6% to $10.9 billion and was 36.1% higher. So obviously with low supply, high demand for rents, we're starting to see a lot more investors coming back into the market. Any comments on the overall lending activity that's happening in the market, Evan?
Oh, just that it's fascinating the way it's ticking up. So despite everything we've been talking about and the pressure that's there and the dual income handling, etc., that it's still moving, right? And again, this is the behavior that I love to talk about, is that time doesn't stand still, and housing is the great one of those, because owner-occupier is the one I always look at, purely for the fact that there is always going to be a new family coming into it because time doesn't stand still. They have to obviously continue to expand the housing that they have because their family expands. There is always going to be somebody entering into their 30s. There's always going to be somebody entering into their 40s and so on and so forth. And it shows that even in tight economic conditions, this keeps moving. And so I think that's what really is catching my attention, is that we're starting to accept this is the fact rather than the abnormal. It's the fact. We have to get on with it. Again, there's lots of arguments to that, and I get it. But it's what you would normally see is that the population's accepting where we're at.
Yeah, I mean, it's still a demand and supply story. There is still, there's people doing it tough, and we respectfully acknowledge those people that times are tough for those people. There are other people who are, in gainful employment, and conditions are pretty good for them to potentially add to their, focus on wealth creation and how they're going to support their family and also themselves in retirement. So you're definitely seeing a blend of that showing up in regards to those who are active and in a position to actually take advantage of the current conditions, with a view that interest rates will eventually come back down to their neutral level. And so this is an opportunity for them to get in. And we just know that there's that strong pent-up demand because of that undersupply. So they're seeing potentially strong growth in rental, and they're also seeing strong growth in capital growth over that time, which does bring us to looking at the results that we saw for released by CoreLogic really for the month of May. I won't go through them. I've done a deep dive with Bryce and I on the property couch when they first came out, because obviously it's a couple of weeks old now, this data. But in summarising, we saw combined capital cities 0.8 growth in the month, and combined regions 0.6 overall nationally, 0.8. So pretty strong growth. We know the hottest markets in the country still remain to be Perth. They still remain to be Adelaide and Brisbane. They are the markets that are moving the most when it comes to that. Which leads me to the final sort of talking point of today's update. I did a bit of analysis, which I'm sharing now, and I've also shared on some of my social channels as well. So over the weekend, I just put some data together, just looking at and working from those median house prices that we do see in each of those capital cities. And so I've taken the view that this is an investor buying a median property in those particular markets. And I'm showcasing here the example of the level of stamp duty, that one-off cost that you do pay to get into the property market. And then what I've also looked at is that land tax. Okay, so we're seeing in terms of different states and territories, the level of land tax, and I've used a land to asset ratio of 60%. So to give you some equivalent understanding of this, this is the data that I did want to spend a little bit of time talking about. And that is that, so if it's a 60% land to asset ratio on a typical home in Sydney of 1.15 mil, what we're talking about there is land values of 693,000. In Victoria, the median house price is 780,000. So that's a land value of 468. In Brisbane, their median now is over Melbourne at 843. Their land value would be 505 at 60%. In terms of Adelaide, 757,000 median house price, very close to Melbourne now. So their land value would be 454. Then you got Perth also moving up strongly at 746,000 land value at 447 at 60%. Hobart, 655,000, their land value 393,000. Darwin, 502,000 is the median. So their land value is only 301, and then Canberra 840,000. So very high, third highest across all the medians, and their land value is 504,000. But let's talk about what the land tax cost would be. So in Canberra, on that 504 is $5,710, 1.1% of the overall value of the property. Ridiculous. And so that's also why they have very, very high rents. You can see in the chart there, the annual rent on that typical property is $31,000. Now, the great story about Darwin, the Northern Territory, and people might, wake up to this, 6.1% yield. So they're getting $30,000 for a typical property up there, but there's no land tax that occurs in the Northern Territory. So people might start sniffing that out from an opportunity point of view. In terms of Hobart, you see land tax of $1,369 on their land value. And so they've got a nice yield of 4.2%. So they get $27,000 of their property. Perth, has a 0.1% land tax, so only $577, but they get $32,000 in gross rent currently in terms of their rental yield. And then Adelaide, no land tax. It falls under the threshold. So there's $27,000 of gross rental income coming in. Brisbane, that also falls under their land tax threshold. So they get, the household gets around $30,000 in terms of gross rental income. Melbourne, here's the story. So Melbourne now obviously only has a $50,000 threshold. So land tax now is one, and they had an increase of 0.1% on overall land tax from January 1. So you're now paying $1,855 in annual land tax. And obviously, because rental yields are still quite low in Victoria, the gross rental yield in rent in Victoria is $24,000. So there is an enormous upside. When you also start thinking about typical median wages in Victoria, rents can move considerably in Victoria and still not be out of parity with those other markets. And then obviously Sydney is another example. You can get the equivalent rent in Canberra as what you can in Sydney at $31,000 on that typical value of that property. But there's no land tax in New South Wales, whereas the state government in Canberra is going to, or the territory is going to get $5,700 of those dollars straight into their coffers. So it should be really eye-opening for an investor to start thinking about this, start thinking about those costs. And ultimately, if there is a shortage of accommodation, you're going to pass on some of those costs to your tenants. And Victoria has the most movement and possibility for some of those costs to be passed on. So I am, as I've always said from the start of the year, I'm predicting that Victorian rents, certainly for houses, will grow stronger than any other market. So really is an interesting piece of data here, isn't it, Evan?
Yeah, it is indeed. And when you showed it to me earlier, I was like, I've been waiting to see this because it's been the big question about the impact that has on inflation as well, right? So the overall number that comes with that is telling. And then you haven't thrown in the changes that could possibly happen around local government, state government sort of laws, and what that also means to driving up the amount of property that's on offer. And that's what's not necessarily included in this, is that already in Victoria, and you're really strong on this, about what has happened to the investment market and the amount of rentable properties in the state of Victoria since the changes around land tax. And that's what's going to be interesting to see with regards to what happens in New South Wales, what also happens in Queensland. They've got a state election coming up. These two ideas have been mooted to see what's been going on in the territory and also down here in Victoria. Do they go along it? And now again, what's happened to the rental market there? Because not only can it catch up Victoria, it could overtake, because again, simple economics of supply and demand could actually see it overtake because we have this massive drop in supply.
Correct. So Victoria was well placed and it was very affordable from a rental accommodation point of view. And obviously, especially if you compare it to Brisbane, right, where their typical rental yield is 3.6%, but that's off the back of pretty strong price growth in Brisbane as opposed to very stagnant price growth in Melbourne. So Melbourne will eventually find its feet, and price growth will eventually bring it to its natural resting equilibrium. But these are the different cycles that are going on. But if you get government intervention where you're taking away that demand, what you're ultimately going to do is take away that real, much needed level of rental accommodation in that particular state. So, and you can see there, it's actually, in relative terms, rent's pretty affordable in Melbourne. So there's a lot more movement that can happen in terms of really strong rental growth that's going to occur potentially in Melbourne. And that will ripple out into, the Ballarats, the Geelongs, and those other regional centres that are still within driving distance of Melbourne. So interesting story. I thought I'd share that with you, in terms of, and to our community in terms of what that looks like. And I'll put that out on socials and be interesting to really see what sort of feedback we get on that particular story. All right, so that brings us now to the wrap. So let's sort of see if we can summarize, Evan. What were some of your sort of, big observations and takeaways over the course of the last 6 weeks? Please share, and then I'll wrap it up from there.
So clearly we've got two different worlds going on around the world. And I think that's the first and foremost. So I know we keep getting questions about why is Canada, why is the UK, why is the ECB cutting rates and we're not? And we sort of showed you in those charts that were there before that the expectation of rate cuts is much higher in those nations because their inflation's lower, but also because they went much harder. I think you need to remember where our cash rate is equivalent to those nations. So Canada is the great one to highlight. Yes, they cut rates at the BOC, but they got up to 5% in their cash rate equivalent, and they're now sitting at 4.75%. They'll probably catch us and overtake us with lower cash rates in the near future, but they've certainly gone harder. It's the same across the ditch, and you look at what's going on over in the Tasman.
Yeah.
So that's my first thing, is that do not compare ourselves with other nations with regards to rate cuts. You just will find yourself getting quite annoyed, and that's the term, annoyed about what's going on. Remember, we've benefited from not going as hard as they have on the backside now that they're coming down. The other thing to really highlight that's starting to really catch my contention on that as well is the RBA's impatience. I don't think we can not say that and not summarise this talk without saying the RBA is well and truly out there saying very clearly that if we have to act alone and go it alone, we're going to do it. And that's what we've seen, is that they are saying very clearly that if we have to be the big kids in the room, we're going to be it.
Yeah, I mean, that's the jawboning that we talk about and the signalling that they're sort of talking to, and tough decisions. I mean, they're mandated to do two things, and that is to obviously run monetary policy, and obviously that's the cash in the economy and managing inflation, but also trying to retain the number of full employment, as much employment as they can retain, and that's that narrow path that they're talking about. So right now, it's definitely, the next lot of data that we're seeing about a slowing economy. Hopefully that continues, because that's exactly the pumping of the brakes that we see happening. And then obviously from a property point of view, what we are potentially going to see is we saw a lot of movement in the early part of the year anticipating rate cuts. Now with potential rate cuts, not necessarily on the short-term horizon, that will probably mean that there will be a bigger window for buying opportunities for those who want to get into the market, taking a more broader, say, 24-month view or 36-month view, where rates will come back down to that more neutral setting. And then you're going to see, obviously, a bit of a rush in terms of what comes into the market at that point in time, depending on how slow the economy is slowed down as part of that. So there it is. There's the wrap. We went deep on, obviously, GDP. We went deep on the inflation story. We did a really, sort of solid dive into that employment story in Australia as well. And then, just some sort of food for thought conversations around costs in running investment properties and where the value sits, and hopefully also telling, the governments and the regulators that if you keep costing investors out, these small business property owners, you're not going to get the supply that you need, because you're not going to get the pre-builds and the pre-sales for the developers to build all this stuff, and that ultimately mean you'll get a stronger contraction of supply. So rather than sort of taxing us out of the game, think about ways in which you can incentivize the market and get that investment stimulus that we're seeing in other markets where governments are effectively more accommodative of small business property investors, as opposed to other states where they're trying to tax us out of the game. So thanks very much for watching. We'll be back again in August for our next update. And so until then, just always remember, knowledge is empowering, but only if you act on it.